Hey guys, welcome back to the channel. Brad here. So today I want to talk about 4 of my top books for stock market beginners. You know, the stock market, it's a fairly complicated realm, and it's easy to get confused with all of the things that you could focus on and pay attention to. But I found these 4 books that I'm going to be sharing really kind of distill down to the essentials when it comes to investing in the stock market. I kind of, tease away all of the chaff to get to the grain, the seeds of what's important. So let's get into it. The first one I want to talk about is this book, 100 Baggers by Christopher Mayer. So the book that inspired him to write this was called 100 to 1 in the Stock Market by a guy named Phelps. I think that was published in the mid-70s. So this guy Phelps, he was looking for stocks where if you had invested $1, you'd have $100 at some point within that period between 1932 and 1971. So stocks that gave you 100 to 1 return, called 100 baggers. And he found 365 stocks that were able to generate these kinds of returns. Now, Christopher Mayer, he spent about $50,000 just trying to get the data to find these 100 baggers. And his study was between the year of 1962 and 2014. So, by strange coincidence, he also found 365 companies that were able to generate 100 to 1 return sometime within that period. And it's a really interesting book. It kind of dives into some of the commonalities, some of the patterns he saw between these 100 baggers. So yeah, it's an interesting read. He also has a newsletter that I read. I think it comes either twice a month or once a month. And it usually has some really interesting insights about what's happening in the market, companies that his firm is investing in. I find it to be a very worthwhile read. So if you want, if you want to check out that newsletter, let me know in the comments. I'll hook you up with that. So that's the first one, 100 baggers, stocks that return 100 to 1 and how to find them. The second is this book, The Little Book That Still Beats the Market by Joel Greenblatt. So Greenblatt, he's one of the few guys I've ever heard of who I believe is a university professor, and he was a hedge fund manager. So he spent time both in the academic realm and on Wall Street. And he's a legend in Wall Street. I think he generated somewhere like 40% annual returns for like 20 years, which is insane. The fund got so big that the strategies that he was using, which was really finding smaller opportunities like spin-offs, mergers and acquisitions, things, leveraged buyouts, things that a lot of investors didn't really understand. And so he was able to find mispricings in these things. But, as the fund grew so big after achieving 40% annual returns, eventually he had to just return the money to the investors. And, I think he's just managing his own money now. So, but anyway, this book, The Little Book That Beats the Market, it's a really great book in terms of understanding how to think about the stock market. So at one point, Buffett said there are 2 things that you need to learn to be a good investor. One is how to value a business, and the other is how to think about market psychology, how to really understand that stock price in the stock market is not the same as the value of a stock, the value of the underlying business. And he just does a really great job kind of explaining that and helping people understand that through this book. He's a great educator. The other thing he does in this book So he came up with a screening tool called the magic formula, and it uses two different metrics to screen companies. The first is earnings yield, which is essentially the inverse of the PE ratio. So it's earnings divided by essentially value, okay? So that's designed to kind of get at how cheap a company is, okay? Now the second metric is return on invested capital. And that's a measure of how good a company is. And he really picked this up from Warren Buffett, the idea that, you know, early on in Buffett's career, he was really focused on cigarette butts, companies that could be bought for less than their scrap value, okay? But, you know, then Warren Buffett, of course, met Charlie Munger, and Charlie kind of helped Warren understand, all right, yeah, you've been doing okay picking up these cigarette butts and getting one last puff out of them, right? Companies that are on the verge of having to be scrapped, not compelling businesses. And what Charlie Munger understood is that if you can get a business that's a great business, even if it's at a fair price, because you have such a high internal rate of return where the company, you know, takes in investor dollars and it can reinvest that money into internal projects that have a really high rate of return, which is return on invested capital, that company has much better compounding effects than, you know, if you find these cigarette butts and just keep doing that over and over again. That's another issue. When you take that approach, you have to find opportunity after opportunity, and you're not in it that long. You know, you're in and out, and then you got to find the next thing. When you get a company like See's Candy or Geico or American Express, some of these companies that, you know, Buffett and Munger have held for many years, that's really where you get the compound power of having a great business. And that's where your money really starts to take off. So this book, you know, that's where the return on invested capital came in. That's Greenblatt's kind of metric for how good a business is. And he found that when you combine these two metrics and you rank companies by their aggregate score, so not just good, not just cheap, but combination of good and cheap, he found that doing that produced really outstanding returns when you build a portfolio around that combined score. And he kind of proposes an approach in this book based on the magic formula where you buy, I think it's 20 to 30 stocks each year based on this screen. And I mean, if you do that with companies that have a market cap over 50 million, which is still very small, he's generating annual returns of, I think it's like 24% a year with no thinking. Just, okay, here's the companies, buy, sell, boom, done. So anyway, this guy's a legend. Highly recommend this book, the little book that beats the market. Number 3 in the list, The Dondo Investor by Monish Pabrai. And it's called The Low Risk Value Method to High Returns. And you might think, low risk and high returns? Well, that doesn't make a lot of sense. Well, that's what most people think. In business school, they teach that in order to get higher returns, you have to take more risk. But, you know, in the value investing approach, which is what Warren Buffett, Charlie Munger, Monish Pabrai follow, if you can identify opportunities where the price of a share of a company, a price of a stock, is significantly lower than the value of a stock. And in future videos, I'm going to be going into how to value a business. But if you find a situation where the price is a lot lower than the value, and you have to be correct, or at least approximately correct in your determination of what the value is. You know, the company's not just going to tell you what the value of a share is. You actually have to figure that out using different estimates and assumptions. And so those assumptions have to be reasonable. But if you can find those opportunities where you have a high margin of safety, you're buying at a significant discount from the value, you can have both low risk and high returns. Because really what risk is it's risk of losing money. And if you buy something at a deep enough discount from what it's worth, you have virtually no risk of losing money, okay? And you have a high chance also of making a lot of money. So that's where the low risk, high returns concept comes from. And Pabrai does a great job in this book he talks about Richard Branson and how Branson would structure all the businesses that he would start so that if it fails, he's not going to lose much. And it really takes some cleverness and craftiness to be able to kind of test a business model with very limited downside. He also talks about the Patels and how they would come over from India and they would buy up these motels. And they would do it at times when the prices were really depressed. And then they would have the whole family working in the motel. So they have virtually zero operating costs because, the family's working there and living there. So they have very low living expenses and the business has very low operating costs. And so they were able to underprice virtually all of their competition and really grow these wonderful businesses. So there's a number of examples in this book about how you do that, how different entrepreneurs have been able to structure it so you have very low downside and very high upside. You have asymmetric upside to downside. That's what this book is all about. And Pabrai, he's basically my mentor. He does 3 lectures basically every year at different business schools around the world, and he puts those lectures on YouTube. So I just devour those whenever a lecture comes out. It's fantastic. So check those out as well. And then the fourth one, I own this book, but I couldn't find it, but I'm going to give it a shout out anyway. It's called The Most Important Thing by Howard Marks. And if you guys follow me on Instagram, if you're connected with me over there, I basically have been doing a post every day, kind of highlighting one chapter from this book, The Most Important Thing. And it's kind of cheeky. There's no one most important thing. Howard Marks would find himself saying, the most important thing is, dealing with risk. The most important thing is, so basically he has 21 most important things in this book. So it's, it's kind of a cheeky title, but it really, it's an incredible book in terms of helping you wrap your mind around how many aspects are involved in investing. There's a lot to juggle. I found myself in every chapter, I'm like, oh wow, this feels really important. And you get 21 chapters like that, and it's easy to think, oh man, investing it's just so complicated. But a lot of these chapters are kind of connected, they're interrelated, and it's just a great way for a beginning investor to just get all of the different facets of what you need to consider as an investor. The most important things if you want to do well in investing. It's an invaluable resource. I first listened to it on Audible, and I promptly bought it because I needed to scribble all over it and highlight things, and I think I highlighted about half the book. So anyway, check that one out. So just to recap, and I'll recap this in the description as well, 100 Baggers, Christopher Meyer, check out his newsletter as well. The Little Book That Still Beats the Market, Joel Greenblatt. The Dondo Investor by Monish Pabrai. And The Most Important Thing by Howard Marks. If I had to pick one to read first, man, that's tough. You know, it would probably be The Little Book That Beats the Market, just because it really gives you a sense for how the stock market actually works. I think, you know, Greenblatt is just a fabulous teacher, and it's just explained so clearly. So it's a great foundation for before you launch into the other three. Anyway, that's it, guys. 4 top books for stock market beginners. Hope you enjoyed it. Let me know if you have a favorite book. You know, maybe you've read a few already. What really resonated with you? Let me know in the comments. All right, guys, have a great day. Bye.